Hello friends, I wish you a very happy, prosperous, peaceful, fulfilling, loving and wonderful Diwali and a very happy new year. Well, last week and as a matter of fact last couple of weeks in my videos I have been telling you along with my live mint column, which happens to be India's first and only media column to offer statistical analysis to its readers, that it is the retail guys who've been doing all the heavy lifting and the institutional players are merely one side, that is the FIIs are selling and the DIIs, that are domestic investment institutions, are buying. So it is up to the retail guys to pull the markets higher. Now, what you have seen is a bit of nervousness in the broader markets, even though the headline indices have been doing just fine. In the coming few weeks, these are the 10 points that you need to take a special note of and form your trading opinions and trading strategy accordingly. Now, most of these are issues that I have been discussing on my free Telegram channel, which happens to be the priority social media platform that I'm on. Then comes the WhatsApp channel, because on WhatsApp I can't upload PDFs and Excel files, etc., which I can on Telegram. So the things that I have been sharing with you on Telegram and the WhatsApp channels was on the 22nd and 24th of August. I told you that there is a big pile up of inventory in passenger cars, and at that point in time it was 70-75 days. It has now crossed 80-85 days. It would get sticky for banks because there's a whole lot of turnover which is not happening. Then there was a media column that it's not just the auto stocks, but it is the slowdown across the sector. Then we had the RBI governor and the deputy governor warning us about evergreening of loans, about MSME loans, about credit card outstandings, about personal loans, and also loans, personal loans below the value of 50,000 rupees, which many people had borrowed from 2 and 3 lenders, and some of that money was coming into the stock market. Now, I've been warning you about all these issues, and if this borrowed money is coming into the stock market and if stock prices are coming down, there would be risks of delinquencies in these loans, and then that would impact the outlook on banking stocks. Now, on your screen is the warning that Reuters has carried about Indian money lenders bracing themselves up for higher amounts of delinquencies. Now, why is that important? Take a look at this graphic up here. Banking and financial sector stocks, and I don't get tired of repeating this for my online family, that they command a huge amount of weightage. Now, this weightage is telescopic. It changes every month. And as of 31st October, the weightage is 34.25%. That's huge. If at all banking stocks were to get shaky, the entire market, that is the broader base Nifty 50 and other indices, will start to get nervous as well. Banks are getting jittery, and that weightage alone might just pull down other interest rate sensitives. Now, interest rate sensitive stocks is something I have been warning you ever since I told you that I expect cost of funds to go up. Now, USA has sanctioned 19 Indian firms. Take a look at this Indian Express media column, which is as recent as a couple of days ago, before I was at the time of recording this video. Now, these 19 Indian defense and allied associated industries have been sanctioned by the US for trading with Russia and helping Russia in the war effort against Ukraine. Now, that can cause nervousness in defense sector stocks, which have been sort of trader and investor favorites in the recent past. Now, that has a lot of expectation and money riding on this sector, and that could basically upset quite a lot of retail traders. Now, on Monday morning on my Telegram and WhatsApp channels, I gave you a very pointed data-based warning. I gave you the number of stocks in the FNO that have fallen 20% or more. Now, a novice, a newbie technical analyst will tell you that when a stock or any other traded security falls 20% or more, as per the classic Dow theory, it is deemed to be in a bear market. So check out those posts on WhatsApp and Telegram channels. See the number of stocks in the F&O that are trading 20% or more down, and then shockingly see the number of stocks that are more than 10% down. Now, as per Dow theory, 10% and below is deemed to be a serious correction. The number of stocks that are 5% down is huge. We are not even talking about that. So every time there is a rally in these counters, there would be supply coming from higher levels. This is called overhead supply. Now, unless the entire overhead supply is absorbed, the new rally will find it very, very difficult to commence. I kept warning you in my live mint column time and again that it was the retail that was doing all the heavy lifting, and the retail segment has very, very limited firepower, and therefore this rally could get a little shaky, and that's precisely what has happened. Friends, point number 8, MWPL. I've made a dedicated video on MWPL, and if you master this wonderful, wonderful metric, you will have a huge tactical advantage in trading over people and traders who do not know what this indicator is. It's a do-it-yourself indicator. Now, I've been telling you that those stocks which have a huge amount of MWPL are the weak deer. Whenever the lion wants to pounce on a deer for lunch, he'll deliberately catch the weakest one of them all, because there's least effort involved in catching that deer. Now, high MWPL counters are the most vulnerable because any adverse news flow or any adverse sell-off will mean that a lot of people run towards the exit door. Now, that is called a crowded exit. You saw that on 4th of June, you saw that on 23rd of July, you saw that on 5th to 7th August, and you saw that in September. I've been pointing these facts out to you about MWPL, and unfortunately and very sadly, I don't see too many analysts talking about the MWPL, nor do I see retail traders focusing on this. Please master this indicator for your own self. Point number 9, my friends. At the beginning of the year, I told you in this particular video that 2024 will be a year of triggered and engineered bull markets. I very categorically told you, and I repeat the words verbatim. Economic data will be massaged. Promises of reforms will be made because there are elections in 5 dozen countries. 60, yes, 60 countries. This is the largest number of elections in a single calendar year in the history of mankind. A lot of promises, feel-good factor, economic handouts will be given, and there would be a general optimism which will take financial asset prices higher. And then the next year, of course, reality would set in, and then you'll start seeing pro-cyclicality. I have recorded 2 videos on pro and counter cyclicality. Please make it a point to watch these videos, because how to trade the markets in pro-cyclical markets and counter-cyclical markets is something that I've explained in great detail there. The cost of fund theory will play a very, very important role in pro-cyclical markets. I've been telling my online family, I've been pleading with you to please understand the cost of theory concept. I've even referred you to buy Dick Stoken's books. There are excellent books written in the 1990s, but they are evergreen, they are still as valid, and it is the gold standard for anyone who wants to understand how the cost of funds impacts financial markets across bonds, commodities, equities, currencies, name it, and you will. The last item number 10, and this should be worrying you, especially if you have already understood the cost of money concept that I have been telling you since years. Bond yields across the world are rising. That means bond prices are slowly but surely slipping. Now, those of you who have read Dick's Tokens books or have done homework online, even without Dick's work here, would immediately understand what I'm trying to hint at. This is too short a time to explain the entire concept, but when bond yields the world over are slowly being pushed up, believe me, I would be very worried and watch the 7th of November US Federal Reserve meeting to consider interest rates with my ears to the ground and listening extra carefully. Now friends, these 10 points done. Let's get into our regular video and analysis mode. Coming up on your screen is the market roundup window. And as you can see that both the headline indices led by the Bank Nifty went up. The Bank Nifty of course outperformed the Nifty 50 and the US dollar index was more or less unchanged. Now that means it did not lend any particular bearish or bullish weightage on emerging markets, including India. Gold went up marginally, but silver corrected quite significantly. Now we'll come to that in some time. Natural gas went up 5.5%, whereas crude oil was down almost 1%. The USD INR, that is the rupee versus the dollar, went up by 5 basis points, and that tells you that the rupee was marginally weaker. The Indian 10-year benchmark bond yield fell 0.004, and that tells you that bond prices went down marginally. Market capitalization was up 1.77%, which tells you that the buying was somewhat broad-based last week. The MWPL fell, which is very, very routine. We'll come to that in a bit. And post-expiry, this fall is anticipated. The US headline indices fell across the board and thereby provided headwinds to our domestic markets. Friends, I now come to the ratio chart where we see that the Bank Nifty divided by the Nifty 50 has attempted to rise for the third consecutive week in a row. The Bank Nifty versus the Nifty ratio is above its 25-week exponential moving average, which is a 6-month long period, and that's enough for almost majority of all retail investors. Now, I told you that I want the Bank Nifty versus the Nifty ratio to go above at least 2.25, if not 2.40, if a sustained bull market is to come in the equity markets. But that has not yet occurred. But these may just be the early signs, provided there's follow-up buying coming in. Friends, the weekly market roundup done. I now come to our in-house indicators. I start with the MWPL. Remember, according to me, this is one of the most important and critical indicators that you can ever study. Last week, I told you that risk appetite could basically come down because it was the retail doing all the heavy lifting. And sure enough, look at what's happened. After the routine fall on post-expiry, you're seeing a decline to 28.04%. This is the lowest in 20 weeks, which is 5 months. 5 derivative expiries and MWPL has fallen to its lowest. That tells you that retail guys are not writing up big enough checks to initiate fresh long buy and hold positions. Now, unless follow-up buying comes in very, very aggressively, I think the markets could get a little more nervous. Now, this is one of those things which indicates what people are doing. Social media and other electronic and non-electronic platforms are full of people who are talking and giving opinions. But MWPL tells you what they are doing. I would rather follow what people are doing. Now, friends, I come to the stock and index futures turnover. These are 3 concurrent series. So it's November, December and Jan. Routine rallies were seen in the turnover because people normally tend to square up in the October series and reinitiate the same exposure in November. So dual turnover is recorded and therefore this looks like the turnover has risen. Friends, I now come to the advanced decline ratio, and what we are basically seeing is that the advanced decline ratio has jumped. This is an average of all 5 trading sessions in the week, and this is mainly because of the huge buying skew that was reported on the Muhurat session on Friday, which was a token 1 hour session. You take away that advanced decline factor of the Muhurat session, and this blue line would be far more lower. Can this advanced decline ratio sustain at 2.85? I don't think so. Very simply, it means for every 100 losing stocks, there were 285 gaining stocks. Now, this is not really sustainable, but anything above 1 and 1.2 would be definitely a sign of optimism. So let's keep our eyes open and ears to the ground. This is something that I update on my social media channels every single day. My contact coordinates are in the description below this video and in the pinned comment below this video itself, and at the fag end in a graphic format. Friends, I now come to the prompt futures basis analysis. Basis is nothing but discount or premium prevalent in the futures compared to spot. Just like options premium, futures premium also tends to erode over time as expiry approaches. Higher the basis, higher the risk appetite in traders, and as like I said, expiry comes closer, that risk appetite starts going down and the basis falls. Now, the Nifty and Bank Nifty basis has risen because traders have 4 full weeks to play around with before expiry of November comes in, but the basis has not risen half as aggressively as it has risen in the prior months. That means retail traders are not willing to pay top dollar or pay undue amount of money to go long. That's a sign of caution. Now, friends, I come to our in-house indicator impetus. You won't get it anywhere on the internet. You've seen it and trusted it for almost 4 years now. What you are seeing is that the rally in the Nifty was on falling impetus. That means momentum was actually lower. This seemed to have been more of short covering ahead of expiry than absolutely aggressive fresh buying. The Bank Nifty impetus at least nudged a little higher, and that tells me that relatively speaking, more action was on the Bank Nifty where fresh buying is concerned. Follow-up buying, of course, is needed, and this impetus is also something I update on a daily basis on my social media accounts. Please do make it a point to connect with me. Friends, now I come to our in-house indicator, the LWTD, which is quite simply the star of our in-house indicators that I've shared with you so far. This is the weekly version. The daily version data is updated on my social media accounts daily. What you are seeing is the LWTD has risen but still remains in the negative at minus 0.41. The Nifty 50 has gone up above zero after staying for 4 weeks below zero, which means losing every week after week for 4 consecutive weeks. The Nifty 50, has gone up and notched 0.51% gains. But the LWTD staying in the negative tells you that fresh buying momentum is likely to be still lethargic, lazy, and limited. How do you analyze and how do you understand the LWTD? There is a special video right here, and you can understand how this exclusive in-house indicator of ours really works. Friends, our in-house indicators done. I now come to the bond market, and I track the bond markets very, very keenly because this asset class funds the prices of all the other asset classes. Now, the Indian 10-year benchmark bond yield chart on your screen, the weekly chart shows that the bond yields attempted to rise but encountered some amount of resistance at higher levels, wound up losing 4 basis points. Now, what you are seeing is the 25-week exponential moving average overhead. That is what is likely to provide some amount of resistance. Now, I would ideally want the bond yields to close above 6.95, maybe 7, before I start writing out checks for the Indian 10-year sovereign benchmark bonds. Those of you who've been with me long enough will remember how in 2021 October itself, I started telling you to start laddering. You can see that on that tweet on your screen. Now, we've been laddering since almost 3 years now, and we are in a sweet spot because we've laddered at 7.25%, 7.5% plus, and we don't really need to be in a hurry to write out checks, nor do we need to rush in at gilt funds which we exited in the month of March rather profitably. So keep the powder dry, wait for ample opportunities. I'm sure ample opportunities are in the pipeline. The bond market's done. I now come to the Bank Nifty, and as the daily chart on the screen tells you, the Bank Nifty, having notched 1.75% gains last week, rose on 3 out of 5 trading sessions, with Tuesday being the game changer. The rallies made on Tuesday was what is responsible for the Bank Nifty notching weekly gains. The neckline of the unconfirmed head and shoulder pattern wasn't even tested. Why am I saying unconfirmed? Because the price needs to fall below the neckline and stay at least 2% below this neckline for a couple of trading sessions. Only then is the head and shoulder established and activated. This is, of course, as per the classic Dow theory. So the bulls showed improved conviction levels, and follow-up buying will tell us what happens next. The price has closed at the monthly moving average, which is somewhat downwards, and a breakout above that is needed to improve sentiments further. Moving on to the weekly chart, what you are seeing is an inside day formation, or an inside week formation rather, which means the last week's candle body, and as a matter of fact, the entire candle itself was contained within the prior week's candle. That's a sign of indecision. The long shadow above the last week's candle tells us higher levels encountered resistance. The price is just about above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium term outlook is positive for now. Now, bulls must push the Bank Nifty above 52,350 and keep it trading above this level for a sustained upthrust. Any fall and a continuous close below the 51,000 round number will see further weakness coming into this index. Friends, in the week before last, this index was at number 8 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It rose up by 1 notch to end at number 7. That means challenge levels went up. Last week, I estimated a range between 52,325 on the upside and 49,250 on the downside, which was breached on the upside by 30 points alone, because the intraday high on Tuesday was made at 52,355. In the coming week, I estimate a range between 53,225 on the upside and 50,125 on the downside. Friends, to laser precise your trading, both for intraday and swing and buy and hold kind of derivative exposure, do watch and monitor our daily, weekly and monthly pivots that I update on our free Telegram and WhatsApp channels. They will help you significantly in timing the market. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained about 0.5%, and as the daily chart on the screen tells you, this index also rose on 3 out of 5 trading sessions. Here again, like the Bank Nifty, Tuesday was a game changer. The price is below its established, activated and confirmed head and shoulder pattern, because the price is below its red color neckline, which you can see on the daily chart on your screen. And the price is also below its month-long moving average, which itself is sloping downwards, which means the short-term outlook is nervous for now. I had given you a target of the head and shoulder, which is a measuring move in the vicinity of 23,250 levels in the Nifty spot. It remains an open possibility in the coming weeks ahead. Let's now shift to the weekly chart on your screen. The price fell briefly below its 25 weekly moving average, which is a proxy for 6-month long holding on cost of an average bull, which means the medium term outlook is nervous for now. I maintain my view in my last week's video as well as in my live mint article that only a sustained trade above the 25,200 levels will negate the nervousness and revive sentiments entirely. Now, although a lot of my online family, friends, and contacts would think that 25,200 is too far and too stretched as a target, believe me, we need to absorb all the overhead supply. Also, please watch the Bank Nifty for the simple reason which I told you was the weightage of 34.25% of banking and financial sector stocks in the Nifty 50 itself. If the Nifty itself sustains trading below 24,000 levels, which of course is not too far from where we are right now, bulls may just experience some more amount of pressure and inconvenience. Friends, in the week before last, this index was number 11 on the most volatile counters list as per statistical beta ranking I maintain in-house. It fell a whopping 9 notches to number 20. Why? Because the range was very, very narrow and it was the individual stocks that's where most of the action was, and which is why the Nifty fell in rankings. Last week, I advocated a range between 24,825 on the upside and 23,550 on the downside, which held, but more because the range was narrow, not because my analysis was accurate. In the coming week, I estimate a range between 24,925 on the upside and 23,700 on the downside. Friends, in order to get more precision in your trading, please monitor the daily, weekly, monthly pivots that I share on our free Telegram and WhatsApp channels so that you can basically get a whole lot more accuracy in your trades, intraday, swing, and buy and hold. Friends, the Nifty done, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by the virtue of their footprint in the 4 derivative segments on the NSE F&O list. The index futures turnover contribution went up by 3 basis points indicated as a blue line. The stock futures turnover contribution went up by 26 basis points indicated as a red line. Index options contribution went up by 36 basis points indicated as a green line, and the only loser was the stock options turnover, which came down by 65 basis points. It's indicated as a purple line. Now, friends, the index and the stock futures turnover went up sheerly because of expiry. You're squaring up October, initiating the same trade in November, so dual turnover results. Nevertheless, the fact that people are rolling over their trades also is an indication of risk appetite. But the true price discovery mechanism will come in the coming week onwards. Friends, I now come to my own trading strategy for the week ahead. It'll frankly be unchanged. I will trade small exposure just like I've mentioned in this video why, and I'll wait for larger price targets. That way, the risk profile of my trades will be subdued, but the profit potential will remain open. I will also maintain tail risk or hacienda hedges exactly as I've explained to you in this video. And I will remain focused on public sector units for their sheer volatility and high MWPL, which will lead to bigger amount of greed and fear and therefore outsize price moves, which is what a bull or a bear wants. Big price moves so you can trade, provided your risk management and your expertise exists in these trades. Watch this video as to why I advocate watching PSU stocks and trading them more proactively. I recently made a video on why I expect bullion, that is gold and silver, to fall, especially if the stock market falls and mark-to-market pressure occurs. Now that is precisely what is happening. You're seeing gold and silver prices come down as individual prices force traders to square up everything to raise cash. Now that is very, very good news, especially if you've seen that video. There's a trading strategy on an investment strategy rather in that video. The long-term story is still intact, but it is only for patient long-term investors. Where industrial or base metals are concerned, I expect them to encounter resistance on the upside, so rallies will be rather labored. Oil and gas will remain my favored theta decay strategy for the simple reason that these are strategies that have been rewarding traders for many, many quarters, and they should be your blue-eyed boys. Public sector banks, defense stocks, especially after the US sanction announcement on Indian defense sector and 19 companies in particular as per the Indian Express report, will mean higher volatility. So you can trade both ways, bull and bear. Now, power, logistics, energy and oil marketing companies are some other stocks that I will target for generating alpha or sheer price gains. Friends, if there are any more strategies, I would be very happy to share them with you on my social media accounts. Please do connect with me there. Before I sign out of this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become better traders. And hey, please help me by sharing my videos with smart traders like yourselves so I can reach out to a wider audience. I thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Take care. Bye-bye.